Hi everyone, my name is Beth Brown and I am counsel in the pensions group at Mayer Brown. Welcome to this episode. In these episodes, we cover different topics each month, providing an overview of the issues faced by pension industry practitioners and offering some practical insight. Time spent listening to these episodes can count towards solicitors' continuing competence and PMI CPD requirements. All the episodes are available on our Mayer Brown YouTube channel, as well as iTunes, Google Play and Yahoo. You can also subscribe to this channel so that new episodes are shown automatically in your subscriptions feed. Hi everyone. In last month's podcast episode, I talked about the long-awaited Pension Scheme Act 2021 becoming law on the 11th of February. Those of you who are dedicated listeners may remember that I made the point that most of the Act is not yet in force and will not be for some time. When summarising the key changes the Act will introduce, I mentioned that a lot of the detail will actually be set out in regulations. One such set of regulations relates to the new climate change risk reporting requirements. These regulations have been published and are being consulted on at the moment. There are actually two sets of regulations. They are named the Occupational Pension Scheme Climate Change Governance and Reporting Regulations 2021 and the Occupational Pension Scheme Climate Change Governance and Reporting Miscellaneous Provisions and Amendments Regulations 2021. For simplicity, I will just refer to these collectively as regulations in this episode. The consultation on the regulations closed on the 10th of March, and the responses are currently being considered. In this episode, I'm going to summarise what the regulations say. Before delving into the regulations though, I just want to give you all some background. So back in 2016, the United Nations Framework Convention on Climate Change saw the Paris Agreement, which covers climate change, signed. The core was protecting the planet. With this in mind, the Pension Scheme Act introduces a framework in respect of governance and reporting requirements for climate-related risks. Essentially, trustees will be subject to new requirements to ensure that they have in place effective governance in respect of the effects of climate change. Trustees will also have to report certain information, such as an annual climate risk disclosure report, which addresses the scheme's performance against the government's requirements. Right, so now we've set the scene, let's look at what the regulations say. The draft regulations build on the standard trustee knowledge and understanding concept by requiring trustees of occupational pension schemes to have knowledge and understanding of principles relating to the identification, assessment, and management of risks relevant to occupational pension schemes from the effects of climate change. Trustees will also have to establish and maintain oversight of the climate-related risks which are relevant to their scheme, identify climate-related risks and opportunities which they think will have an effect on their scheme's investment strategy, and if the scheme has a funding strategy, the funding strategy as well. This will need to be done over the short, medium and long term. Trustees will also be expected to assess the impact of such risks and opportunities on an ongoing basis. In order to identify, assess and manage climate-related risks for their schemes, trustees will have to establish and maintain processes for doing so, which I expect will, going forward, form part of their standard governance processes. Trustees will also have to ensure that management of climate-related risk is integrated into their overall risk management of the scheme. Another aspect of the ongoing monitoring of climate-related matters is that trustees will have to undertake a scenario analysis, considering at least two scenarios where there is an increase in the global average temperature. A bit like an actuarial valuation, this will need to be undertaken every 3 years. In the interim years, the trustees will still need to consider the scenarios and they'll need to decide if the circumstances are such that their analysis needs to be refreshed, and if not, they have to explain why. Trustees will also have to select at least 2 emissions-based metrics and 1 additional climate-related metric. Then they will have to set a target in relation to at least one of these metrics. Trustees will then have to measure the scheme's performance against the target that they have set at least once a year. And it will come as no surprise, given the general focus on transparency and the introduction of the implementation statement, that trustees will also have to publish an annual report containing certain details relating to the trustees' climate-related risk governance, strategy, and risk management processes. The report must be published within 7 months of the end of the scheme year, be signed by the trustee chairperson, and be published on a website accessible by the public free of charge. The last point I would make about the regulations themselves is that the new obligations are to be phased in. Therefore, they will apply from this October to schemes with over 5 billion in assets, and then from next October to schemes with more than 1 billion of assets. It's worth noting that, as well as the regulations, draft guidance has been produced. The guidance very helpfully summarises the new requirements and sets out whether activities are mandatory, expected, or voluntary. So it should be very clear to trustees what their obligations are. If trustees fail to comply with the new requirements, the pensions regulator can issue a compliance notice. The pensions regulator will also be able to issue fines for up to £5,000 on an individual trustee and £50,000 on a corporate trustee. Given the additional requirements and short timeframes between the regulations coming into force and the first set of trustees having to comply with them, trustees should start considering how they can comply with the new requirements now. I will finish this episode by saying that even though the regulations do not, as currently drafted, require schemes with assets of less than 1 billion to comply with the new requirements, actually trustees of all occupational pension schemes will probably want to start thinking about the new requirements now. This episode is an overview of the law in this area, and how the law will apply in any particular case will depend on the individual circumstances. Please therefore remember to seek legal advice on your particular circumstances.